Welcome to another episode of the Lightspeed Investing Podcast. I'm so glad to have Mr. Kraig Swanson back again. He is the founder of the Swanson Reserve Capital, here to teach us today 3 teaching points of what structured notes really are and how to navigate the markets properly from his experience. Kraig, how are you doing today?
Great, Philip. Thanks for having me back. Excited to be here.
Yeah, man. It's pretty exciting things for the state of Florida as UF won the championship. But I'm not sure if you're super ecstatic about that or not, since there are so many.
I have some friends that are. I guess
Yes,
I lean more towards FSU, but they
gotcha,
haven't been, didn't make
gotcha.
it.
But yeah, man. I mean, hey, I guess it's for them a great day to be a Gator, and happy for the state of Florida. Now, for us, I know you got some great stuff today. So tell me, and the audience, what are like 3 really critical points to know about the structured notes investing space? And what would you have to tell someone who's brand new, who doesn't know anything, right? And they can just pick up some gold nuggets from you.
Yeah, yeah, absolutely. So I guess I'll talk about risk management first and foremost. And if you're meeting with, let's just say you're a new investor and you're meeting with a financial advisor, there's some terms they're going to throw out at you that might sound intimidating. And like any industry, whether you're a doctor or a lawyer, they all have their own nomenclature, right? So I would argue that risk management is the most important thing over and above returns. Someone may argue with me, but obviously if you're risking even more than you may have for outsized returns, and let's just say you were long the S&P 500, and that was 100% your correlation, you got pretty hurt recently, even though we had a nice bounce back today. But I think risk management is extremely important in trading and investing. Absolutely. So, um, some of the things that a financial advisor might talk to you about, which is different than a fund, and I come from the fund background and world, is you might hear the word like Sharpe ratio, which is a risk adjusted return metric. How
Mhm.
much can a stock go up or down based on its standard deviations? But it's interesting that most investors, I'd say, typically are betting on companies to go up. So if you look at just that metric and it's like revered as one of the gold standards, something I actually don't even look at as a fund manager, but it takes in consideration the upside standard deviation and the downside standard deviation. So what that means is like a stock going up and down and up and down. You really want, if you're long, that equity to keep going up, in perpetuity. So it's not really an argument that is like why you would care if stock would go up too much. I don't think anyone's complained about making too much money, but it's interesting, and that's the metric that most financial advisors use and are taught. I'd say Sortino, which takes away that, is something you might want to ask a financial advisor about or just educate yourself on. And there's some pretty cool tools that I use. One that I'm friends with is Portfolio Labs. If you're ever into like building your own portfolios, it's something I would urge you to check out, as it's helped us in the fund, and just different things you can educate yourself with. So proper risk management is a key tool. I'd say that most early investors just get excited and they hear from a friend, hey, I made all this money and I want to try this out. But really, if you're trading, you should have a set percentage that you're willing to risk each trade and just be more systematic about how you're taking that approach. Any hedge fund manager or any, I'd say, like serious investor, they treat it like a business, and you want to make sure that you're protected and not just making big bets based on gut feeling or instinct.
Absolutely. I mean, for us, when we manage money for high net worth individuals, our risk to reward, we aim to be in the risking 1 to make 10, right? That's the ratio. But when we teach, and we have newcomers learning this game, we urge them to just focus on having a proper risk to management ratio, risk to reward ratio of 1 to 3, right? So you're risking, say, 10 points to make 30, not risking 10 to make 100, because that's a bit more advanced. So as you know, we do futures, right? So that's kind of our gauge.
Yeah.
But yeah, I mean that it's a core tenet of proper investing, right? Whether you are just a beginning retail trader or if you're a full-blown fund manager. So
Yeah.
super.
That gives me another thought that I want to comment on. and I'll say that you probably see this on a lot of ads, is I am of the belief that win rate doesn't really matter. It's usually something that if someone's trying to sell you an algorithm, or you see just like, hey, 95% win rate, what's more important is what you just mentioned, that risk to reward.
Yeah.
You need to make sure that you're actually making more than you're losing each time, because you could be winning 90% of the time $1, but losing that extra 5% of the time $100, and that's not profitable. So these are all these things that I've, like, after years of time spent researching and looking at really what works versus what doesn't.
Mhm.
I feel like that's something that's definitely to be looked at when you're reviewing your trading, and you're looking at different things as far as, risk to reward, average risk to your average win to loss ratio is also is things you get to look at. I think that we've taken leaps and bounds from where we were 20 years ago, what we can actually see in our trading or investing versus, what we had back then. So proper risk management is huge. And then another thing I was going to talk about today, to transition, which is I would argue that it's just as important, is the correlation to your investments. And we talk about this to those who want to invest in our fund. If you're invested in general stocks in the market, especially growth stocks, those have a heavier correlation to what we call risk assets, right? So think of the S&P as the market standard. And if you have a risk asset, usually those stocks, if the S&P is going up, those are going to go up over and above. Like, say S&P goes up 5% today, those could go up 10%, sometimes even more the riskier they are. Where we look at non-correlation, and I don't think this is talked about enough, is pretty much all the majors like Amazon, Google, Apple, they, along with several others, make up most of the entire S&P 500. They make up most of the gains. So if those guys are going down, it's more than likely that the NASDAQ or whatever the big, funds that are trading them are going to go down as well. So if you're looking for investments, it's nice to see, and there's ways to kind of look at this too, that I can recommend if you reach out to us. But you want to think about investments, and especially, like, this is why I think you and I both love the futures market, because there's a lot uncorrelated, gold to, the S&P, like there's some inverse correlations, especially the dollar versus the euro. There's different ways you can play the markets where that they're completely inverse, and that gives you an edge on how you can set up for investing. And until you kind of take a little deeper dive in there, most people, and this is coming from someone who spent 11 years at Fidelity with, the golden index funds, just put in an index fund. Index funds are great, but understand that most of those stocks in there, it's just like 250 stocks in one portfolio, where a handful, not even 50, are driving all of your returns. So it kind of pays to be a little bit of a nerd about that and dig into the
Yeah.
research. And
Right.
that's kind of something we do at our fund.
Well, it's in conjunction with Pareto's principle, right? 20% of your inputs gives you 80% of your outputs. So if you do your due diligence right, and you study it the right way, then you can have the most efficient work, right? Investing wise and trading wise, by understanding how each markets are correlated. Because it's a great way to trade stock options as well, right? You want to kind of see how the markets are doing, and then you can trade certain stock options accordingly, depending on if they are aligned or if they are asymmetric, right, to those markets. But that way, you have a reference point to trade those markets that gives you better insights as to, okay, well, since these markets are correlated and I see them, going up accordingly, it's probably safe for me to buy that call as opposed to buying that put, right? But if it's asymmetric, then you're like, okay, maybe it's better if I go the other way on that certain stock option. So, no, absolutely. So risk mitigation, right? Markets correlation are two very important four pillars, any investors to pay attention to. What would you say is your third and final gold nugget that you would like to share to the audience?
Yeah,
Or
and so I'm going to tie this all together and talk a little bit about how I take both of those pieces, proper risk management and non-correlated investments, and how we tie that into structured note investing. And just really quick, I'm going to tie this into sports, because most people know sports really well, and compare it to kind of basketball and football. So just to start, what is a structured note? I'm sure most people are asking. A structured note is a hybrid debt security. So Goldman Sachs, JP Morgan, all the big investment banks, they have these, right?
Mhm.
To get access to them, you generally have to be an advisor or an institution. We qualify on the advisor side. So what we do is we take those principles we just talked about, and I'll explain it in the three ways we buy these. So pretend you own your own basketball team. Pretend you own the Jayhawks, Philip, or the
Yeah.
Miami Heat.
Yeah.
Either
Actually,
one.
that's funny. You have a Florida. I do have my Miami Heat today. Yeah.
Nice. So you got both. So you're up there in the owner's box and you're the owner of the team.
Yeah.
This is how I can kind of relate this to a type of structured notes that we buy. So if you're the owner, you're not out there, and I know you like to play, but I know you wouldn't be out there, being able to catch an elbow or get an injury. You're not taking that risk as much as the players are, but when your team wins, you get to share in that win. You
Yeah.
got ownership in the team. You're managing the team. And I compare that to how we buy principal protected structured notes. So the way that works is we can buy a note that follows any stock, any index. And if that index goes up, that's our team. We get to participate in that win, but we don't participate in any losses. We don't have any risk of injury because it's 100% backed by the good faith and credit of JP Morgan and Goldman Sachs. So you can think of them as the Miami Heat of the banking world. So that's this, I would argue, pretty clearly that that's the safest way to get exposed to structured notes. But again, you could be buying that like gold and the S&P. One could argue there's an inverse relationship there. So you could have structured notes on assets that you would think would complement each other. And that's the things we look at. So it's a whole different way to add a protection layer, add
Uh-huh.
an uncorrelation layer, and still be chilling in the owner's box and watching hopefully your teams and your players that you're picking do well. So I'll bring you to player number two, and it's arguably one of my favorites. What's the old adage is that defense wins championships. So I'm trying to pick a great defensive player. Maybe you can give me one for basketball
Drew
that you like.
Holiday. Drew Holiday.
Okay, Drew
Marcus.
Holiday.
Yeah.
Let's pick Drew Holiday. So every player in the NBA or the NFL, they all get contracts, right? So we'll pretend structured notes are a contract, and they technically are a contract note of here's what you're going to get, here's what you're picking. So we go out and we try to find the best players to play defense. Their whole job on defense, right, is to not let the other team score. Now, in this case, our players are the equities or indices that we're picking, and we don't want them to go against us. We don't want to lose the game, right? But we're already starting that game with at least a 50, and this is how we buy them, but a 50% hedge on all our players' contracts. So the way it works is as long as our players don't get hurt or they don't lose the game, we're already starting up, put it this way, already starting up basically 25-0 on protection, or 50-0 on protection. The other team has to score 60 points, and we can't score nothing until we start to really sweat. So we come with an inherent protection on every defensive investment we take, and then we get paid every month if those players don't get hurt over 50%, if that makes sense.
Mhm. Now,
So
what
it's
is what is the term? So, like, what is the term that you would use for the owners analogy? What is the term you would use for the defense analogy?
Yeah. So the owners would be the principal protected notes. They're backed by the bank 100%. You cannot lose money, but you're taking advantage when your team wins, so you can participate in that upside.
And that's like level one. That's the most like conservative. Or is that
Oh,
like
absolutely.
okay?
I'd say that's the most conservative. You
Okay.
can play structured products.
Okay.
There's FDIC ones as well. I mean, those are backed by the
So, what is the
government.
percentage we're looking at here? Because that's important, right? Like the ROI, etc.
For our fund, 10 to 12%. Sometimes it's uncapped following the lesser performing. Like I have one on Tesla, Nvidia, and Amazon. So whatever performs least, and we do analysis on, hey, over the past 5 years, what's the average return? And for Amazon was actually one of the lower ones at 18.5%. So you can virtually risk the risk is Goldman Sachs going out of business, which if that happens, God bless us all, because something bad's going on. You can make up to whatever that equity will perform at for that given period.
When you say 10 to 12%, what is the time frame? Annual, monthly,
That's on an
and annual? Okay,
annual
so that's why it's
basis.
the most conservative. And that's
Yeah,
level
yeah.
one.
There's capped upsides on some.
Yeah.
They're all a little different, just like all like players you procure can be a little different on their contract. But those generally yield the lowest, as you can imagine.
Gotcha. And what's the barrier to entry? What do you got to go in at?
They're issued in denominations of $1,000,
Gotcha.
and we tend to we do what's called customs. So we create our own player contract, if you will, and we aggregate with other parties, partners of mine. If you're doing a custom, it could be anywhere from 500,000 to $1 million. But there's ways to, if you have access to an advisor who understands them, you can generally get started if they know what they're doing.
Huh.
With a little $1,000, if you have a
Gotcha.
connect.
So that's your, number, I would say, one, more conservative, get in the door, you're the team owner, that concept. You can start as low as $1,000. Is that what you're saying? As low
Yep.
as 1,000?
Yep. If you have
You're-
access to someone and you can tag on, like you wouldn't be buying a custom contract yourself. You would be ideally like you're tagging on to
okay.
existing.
And so that would be 10 to 12% annual on the conservative level. Then the
Yep.
second tier is where defense wins championships. Do you want to talk about the barrier to entry and then the ROI as well?
Yeah, yeah. So it can vary. Like we'll look at notes that are at least going to make arguably 17 to 20+%. And the goal of these is very different in investing. When you're buying something to go along in the markets, this is purely defensive. We don't even care if the stocks go up. If they stay in a range, it's actually preferable because we just want it to not play. Again, we're playing defense against the market. We don't want it to come
Yep.
against us
Right.
50%. And as long as it stays within that in our time frame, we are making coupon payments every month. And we can I've seen some on, when volatility is high, there's some on Tesla that are paying 39% a year. Sometimes more. It just depends on where you can access that style of
But the minimum to go in on this one is
same thing on a custom. It's about the 500,000 to
see.
$1 million in some cases, but again, it's denominations of 1,000. So if this was like being offered by a provider that we know and you have an access to them, $1,000 denomination, same thing.
I see. And then the third level would be
The third level, I'm gonna have you pick your favorite basketball, like just star, scorer, leader, because these
does
are
it matter
probably
what time frame? Like what era?
Nope,
I
nope.
mean, I mean, dude, like you gotta give your hands up for Gary Payton because he's the only guard that won Defensive Player of the Year. So only point guard. So I mean, he's a little bit more old school, but yeah,
I
man.
know Gary. I know Gary.
Yeah, yeah.
Yeah,
I actually,
yeah.
yeah, I was able to meet him like 2 weeks ago, so that was pretty cool.
Yeah, Gary would be, in my view, if I had to relate it to structured notes, is like the fixed income structured notes. So we have some that we can procure no matter what happens. The stock, the indices, they could go to zero, but whatever that fixed return is, we're getting that. Whether it's 15%. Generally, those are a little lower because it's like a guaranteed return, but you can still lose. Don't get me wrong, you can still lose money on the equity if it goes down. But that's a fixed return note. And so there's all these different types of bolt-ons that we add, that I won't go into on this call, but there's protection features you can get really, really creative with to make sure that if any one of those stocks goes down, let's just say, you can actually be 100% principal protected if even one just ends up a penny in the time frame in which you invested.
And you're talking about the same thing, denominations of
Yep.
1,000 or in the custom. Okay, so they're all the same. So really, you have
Yep.
like level one, you're the team owner, 10 to 12% annually. Then you have tier two, you're playing defense against the markets, right? It's to mitigate losses, right? You're not really looking to win, you're
Correct.
mitigating losses.
Exactly.
And that can generate about 17% annually.
Yep.
And same thing, right? Denominations are 1,000 custom. And then the third tier, that's when you are the player. I just want to make sure like that I get the analogy down.
Yeah, the third tier, I was gonna have you pick your favorite like scorer basketball player because when I compare
Score.
these,
Kobe.
these are
Let's go with
called
Kobe.
all
Yeah.
right, Kobe
Yeah. Kobe.
Bryant, like
Yeah.
amazing. So obviously he's a leader. He's a scorer. He's one of the best players. And what we do on that side to be comparative to structured note investing is we call these growth notes. So basically you participate in the growth of any of the equities tied to a structured note. Same thing in that you get the defensive 50% protection, but these things make way more. This is the highest yielding note that you can have. And so we buy stuff, if you're comparing it to basketball, it's a player contract where we're trying to put together the best growth equities. Again, non-correlated, so we have some in the cyber security space. We may have some in the oil and gas space, and based on analysis, these can do well, but they move differently from each other. If they do well, you can make well above 20%. I mean, I have one, the highest I've ever seen. Tesla was in it, and Tesla was falling. It was Tesla, Amazon, and Apple. It was a 69% growth note, meaning if Kobe just gets one layup point up and we have 3 Kobe's on the team, we're making 69%. Those stocks just need to go up 1 penny in the period of a year. We're making 69% on that note, on whatever the principal was.
But what's the minimum on that, like on that structure? What do you guarantee your investors? Do you guarantee your investors anything with growth notes?
In the fund, we do 17% per annum. And on the growth notes, we're creating a blend of growth notes for them. So in the guarantees, there is no guarantees in investing. I mean, in our fund, we have legal document that says we're going to get you this return. But growth notes, it's if this happens, you will get X, if that makes sense. Principal protected.
Do you have a baseline? Do you have a minimum return that you project to your investors at all?
Growth notes?
Yeah.
We target in the blend that we buy at least, I don't even look at anything if it's not 19 to 20%. Yeah.
I see.
Minimum.
I see. So it's a staircase up. So the level 1, your team owner, that's 10 to 20 annual. Level 2, you are playing defense against the markets. That's
right.
About what, 17%. And then here you're looking at growth notes. You're a scorer, and you're looking to yield at least 19 to 20%.
Yep, I'd say even higher than that.
Even higher than that. And
that's
even
going to fetch the higher returns.
And across all 3, you have the same thing, right? Denominations of 1,000, and then the custom 500,000 to actual 1 million. But the question is, what about potential losses, right? So how do you, so if you're scoring and you're looking at 20%, what are, can it go against you, and what do you do there?
Yeah, so that's a great question. We've invested into 163 different structured notes. So we talked today about risk management. We talked today about non-correlation, and then how those relate to sports. So really it comes down to, this is an even playing field. Like if you were to go out and play basketball today, we practice on who we want to select for our equities. We do a ton of analysis on, hey, is this correlated to this sector? Is this correlated to this sector? Has this ever fallen 50% in that given time period? And what's the probability of that happening? So we do a lot of analysis on that side. And I can tell you with confidence, it's about a 98% success rate, and that never occurring. And if it does, I may look at and primarily happens on the defensive sector of the portfolio. I've had one go below the barrier of the 50% protection. However, I knew it would be this equity, and I bought a pretty fair size put option on it. So I always try to stay hedged, no matter if this equity wasn't paying for a period. I already know which ones in the lineup, which players in the lineup are apt to get hurt, if that makes sense.
And again, just like for simple sake, like what are the actual terminology? So like in my head, I'm like team owner, but what's the name of the note? Team owner.
Principal protected.
Principal protected note. And then you have defense against the markets, which is called
income notes.
Income notes. And then you have the scorer, which is the growth notes.
Growth notes. And there is a zillion variations of all those, so I won't complicate those.
As you go higher, would you say you're also taking on more risk because you're getting I would say you're projecting higher returns as you go up the ladder?
I would say that that's a fair correlation. And the more protection features you put on any of those notes, because I didn't go into that on today's call, which we do put on, it reduces the return. So I can put something, and I'll leave you with this. It's called memory, and that's for the defensive income notes. Say you got 3 stocks, 3 players, and you have the 50% protection, and let's say Amazon, Apple, Tesla, and Tesla goes to 0. Amazon goes to 0, but Apple's still up 1 penny. If I have this protection feature attached to it, it will actually mean that I have no loss of principal at any
Yeah.
point. You know, so
Okay.
there's different things we can put on there into the player contracts, if you will, that clearly, you know, the risk reward factor does factor in. There's definitely not a place where, you know, if you can find that, my LinkedIn is at Kraig Swanson. If you can tell me there's a risk-free investment where I can make well above that, I'm open to
Yeah.
hearing it. But usually there's a correlation to risk reward.
Love it, man. Love it. Well, hey, it's always a pleasure. Thank you so much for being on here today, teaching us, me and the audience, a bit more about structured notes and your tenets, your core tenets of investing. If anyone wants to get in touch with you to talk about how to get involved with structured notes, what is the best way?
I'd say you could go to our website at www.swansonreservecapital.com. Or if you're active on socials, we're pretty active on LinkedIn, and that's just at Kraig Swanson. So you can shoot me a DM on there.
Awesome, man. Well, hey, thank you so much. I know that, in the evenings you got a family to tend to, so I want to leave you some good time to have a good family dinner. And I'll see you next time when we talk again, okay?
All right. Thanks, Philip.
All right, man.
Appreciate it.
Thank you. Yep, appreciate you.